All right, yield nerds, I was gonna show up with an eye patch, so I will look like that vigilante over there. I want to share some amazing news with you. My returns year to date are 6 times that of Nasdaq on my equity portfolio. I'm gonna tell you how I did that, and I also want to introduce you to the bond vigilantes that I think will be showing up in short order. Let's get started. We are at 448 subscribers. I am incredibly honored. I created another playlist for you called Eel Super Bowl. We play that game here quite often. And if you go to that playlist, you will find videos that talk about Eel Super Bowl and what it is. But if you want to follow our show in a chronological order, you can use the income investing roadmap. And there is also the playlist called Preferred Stocks, which dives into that. Most importantly, and to make sure that there is no hubris here, please know that I am wrong and I'm sharing my research. This is education, and so make sure you check whatever I'm saying here and make your own decisions. Well, 4 parts to today. One is the market temperature, where I will arrive in my pirate ship and share with you how I made this giant bounty. And then we'll talk about who the bond vigilantes are and what does it mean to be a bond vigilante. And then we'll talk about my investment thesis and what I'm doing based on that. Hey, I told you 6 times the NASDAQ performance, and I want to prove it to you. Here you go. The NASDAQ made 1.04% year to date, and I am at 5.99%. So this year has been very kind to me. And the last 3 months have been very kind to me. NASDAQ making 6.5%, and I'm at close to 19%. And you can see some very steep appreciations of that. And I'm going to share how I traded, what I did, and what I'm looking for next week as well. Now, for those of you looking at this portfolio thinking somehow I pulled a rabbit out of a hat, I'm not doing that on 100% of my portfolio by any means. My portfolio is largely fixed income, and my entire portfolio is up by 6% year to date, and it is still enjoying a very nice resurgence this year, mainly driven by some amazing returns in equities on a small allocation. So having said that, let me go to the thrust of what we are here to talk about, the bond vigilantes that are sailing into Wall Street, at least I think they are. So what does it mean to be a bond vigilante? Before I go further, I want to make sure that I communicate very clearly that I am not a wealth management advisor. This is not investment advice, it's education, and I don't have products to sell. I don't do politics or t-shirts or lotions or potions. I'm sharing what I learned. So remember the Eel Super Bowl. And if you don't know what it is, there is a playlist, as I told you. What we can see is that a year ago, approximately a year and a half ago, we had incredibly high short-term yields. Those dramatically dropped. The entire curve dropped, short and long term. But off late, the tail end of it is lifting up. And that is what we call bear steepening. And if that goes berserk, meaning if the tail end goes really, really high, that is what we would call a bond vigilantism, which drives long-term yields up. And for those of you that are not aware, could that ever happen? Yes, it can, and it did in 2013. And I put a reference to this article, feel free to read it. And at that point, it was Chairman Ben Bernanke. He announces that, hey, maybe we won't be throwing a lot of free money soon. And the market said, "Oh my God, what do you mean no free money?" And the announcement that there may not be as much quantitative easing as it's called, that alone caused the bond market to go nuts. And lucky for us, on that time, during that duration, the equity market did not crash. Chairman Bernanke did not continue with quantitative easing, and the market kind of stabilized. And so there are wiser ways of doing that now. But having said that, at the end of the day, there may be a different reason bond vigilantes may show up. And let me explain what I mean. There may be some loss in confidence that deficit will be curtailed, and there are many reasons why. There may also be indications that short-term interest rates are not going to drop as promised. That will also cause some bond jitters. And long-term bonds, if the fiscal stability of the country is being doubted, that will cause problems. There is a debt ceiling debate coming up. And last but not the least, stocks may not deliver the earnings they said they would deliver. And if stocks crash, bonds will go along with it. And when bonds decrease in price, they increase in yield. And that is really what you are seeing here on the tail end. So when all of that happens, the US dollar will lose its power. Now, this seems like hell in a handbasket and things that cannot happen. So let's kind of look at what could happen, each one of those risk factors. Let's look at deficit risk. Do we truly believe deficits are going to decrease dramatically very soon? Well, one of the ways deficit can be plugged is by tax increases, not tax cuts. The new administration is talking about either keeping tax cuts that are already there or maybe offering new tax cuts. You do the math, that flies in the face of decreasing deficits, so the bond vigilantes might get excited. Spending. There is a lot of talk about decreasing government spending. How fast can you do it and how much can you do it are questions the bond market will ask. And if the bond market doesn't get the feeling that, oh my God, this is going to get curtailed soon, then there will be some jitters. New wars. And, there's some stuff in the Middle East that is going on, some of it peaceful, some of it not. There are new countries that we're trying to enforce sanctions on. Those things could create conflict. And if that happens, the bond market will again have trouble. Last but not the least, we may have wonderful ideas, but Congress may not be able to get it through because of, the majority is very slim. You still need everybody to agree, and that hasn't happened in a long time. So all of these put together, the confidence that deficit would come down may not be high, and it may create problems. What about interest rates? Let's read the press. There is a lot of talk about the number of cuts in 2025 may not be as many as, Chairman Powell indicated. Even in 2024, there was talk of 5 cuts. It became 3. There was a talk of 5 projected cuts in 2025. That became maybe 2, maybe 3. Nobody knows. If the cuts don't come and mortgage rates keep going above 7%, eventually it will pull things down. The only way to stop that is to print more money. Well, when you print more money, it's going to increase the deficit. You see where I'm going. These things will fight each other and create a bigger and bigger problem. And so if I were to argue for the bond vigilantes, I would say, maybe they have a point. Deficit, there is a real risk. Interest rate, there is a real risk. And let's look at another point in support of the bond vigilantes. Look at the long-term rates. These are the 10-year Treasury rates. They have gone meteorically higher, 30% higher in the last 5 months. And that is insane. Imagine owning a bond that you bought for $100 and now it's $130. That's the kind of return you can make even in fixed income if you played your card smartly. And so that is what this is illustrating, that if the bond market throws a tantrum, then you can have huge swings in yield, and you just need to be smart about when to play and where to play. So now that I've played the cards off the bond vigilantes, I'm going to go against them and say, but hold on, these bond vigilante pirate people. That is never going to happen unless there is an earnings recession. And let's see how earnings are doing for the companies that have indeed announced earnings. And I'm going to very kindly point out, hey, the financial sector has announced earnings. Every single bank has come out and smashed their earnings. Hint, hint. If you watched the previous episode, you will know that this quarter alone, there is an accounting gimmick that enables them to not count certain reserves or deduct them from their earnings. So there are accounting reasons why earnings are higher, and there are also other reasons why earnings are higher. Either way, banks are coming out shining clean, and that is keeping the market up. The non-bank companies, the HB Fullers, Concentrics, they did miss earnings. So early indications are financial sector is doing great. And then let's go once again and look at the second day of financials. Everything except the steel company crushed earnings. So you could sit here and say, what earnings recession? These bond people, they are wrong. The stock market is doing great, and therefore it's going to keep going up, up, and up. There isn't going to be jitters in the long-term bonds. You are wrong. And I would very humbly tell you, let me roll out the next week for you. Big Pharma is going to give earnings. The steel industry, where there's a lot of turmoil, is going to give out earnings. Airlines, with a lot of these storms and floods that happened, that is going to give earnings. And those industries, if they do not meet expectations, which granted are somewhat tempered, they aren't required to produce the same kind of earnings as they did in 2023 Q4. 2024 Q4 already is setting lower expectations. But if a good percentage of them do not meet those earnings, we got problems coming next week. So let's talk about what could happen. And I'm now going to argue again in favor of the long-term bonds rising up. We already know TikTok has been banned. There is a lot of talk of how it could be resurrected. Let's assume that fails. And China turns around and says, well, I'm going to ban Google. And the US says, wait, you ban Google, I'm going to ban whatever. And this escalates. And that could then drive inflation fears with tariffs. And that could drive the price of the 10-year bond down, which means it drives the yield up. This could happen starting next week. What else? Well, we have allegedly 100 executive orders coming out. You have to imagine reasonable people cannot agree on the color blue these days. And especially with a divided country, somebody somewhere is going to get upset with one or more of the executive orders, and that creates jitters. So between stirring up some international, emotions with the TikTok ban, possible tariffs, possible executive orders, and next week's sectors announcing earnings not looking super strong, my investment thesis, and realize I only have a couple of percentage points on the stock market, on the equity market. Most of mine are bonds, short-term bonds. My investment thesis of next week is that the companies that are going to release earnings next week aren't going to crush it like the financial industry. And I expect somebody somewhere to be upset with some of these executive orders, and the fear of a tariff creates some retaliation. And I am counting on panic in the market next week. Who knows? And I'm also looking for increase in the long-term yield next week. And what did I do? I cleaned out a whole bunch of my equities and went to cash. And here are some of the ones that I owned and sold. I rode the quantum wave up one more time. And I did own Meta. Look up what happened to Meta last week. They announced layoffs. Stocks went up by 5%. I benefited from that. I owned Fannie Mae, Freddie Mac. Look up their stock, and you will see magic that happened there. And every one of these contributed to greater than index growth. And that is why my performance was 6 times that of Nasdaq. Another one, I did talk about this in the previous episode, that the financial sector is going to have an unusually good earnings season. I handpicked OZK, Bank of the Ozark, and I bought their stock, made 20% on that. By the time I made these allocations in equities, I had a really good return on that. However, I have crawled back into a hole. I went from 2.7% to 1.8% in equities, but I'm sitting idle with cash, waiting for next week, hoping to pounce. And here is where my holdings are, and that bond vigilante looks a little scary to me. Um, well, some of these are what I already owned, but I am preparing for war. I am preparing for some level of excitement there. So I still have Curtis, I have Kratos, but given all these natural disasters, Los Angeles and the storms, I'm hanging on to a bunch of reconstruction stocks, which are doing phenomenally. And outside of that, Target is a 5-year low. I am looking at more war stocks, oil, and I picked up Ollie's Bargain Outlet. And look it up. It's a very interesting stock in the sense that when the economy goes down, people are going to shop for bargain outlets instead of the dollar store. This is kind of a compromise. And so I'm picking up Ollie's. And outside of it, I'm sitting tight. I have a dark horse here called Renovo RX, and they are going to come out with some trial results. And I'm excited by their momentum. The last 3 months showed a 50% increase in share price, so I'm trying to see what's going on there. Outside of those, I am mostly in cash, waiting for turmoil next week. You do you, and thank you for watching Yield Nerd.